Trade execution is a critical component of portfolio management because investment decisions generate value only when they are implemented efficiently in financial markets. Even a superior investment idea can fail to produce expected returns if execution costs are excessive or market conditions change before the trade is completed. Portfolio managers must therefore understand why trades occur, how execution quality is measured, and which implementation strategies best align with investment objectives. The execution process requires balancing competing considerations such as speed, cost, market impact, information leakage, and risk. Effective trade execution seeks to maximize realized investment value while minimizing transaction costs and preserving the portfolio manager's intended exposures. Trades arise from a variety of motivations that reflect both strategic and operational portfolio needs. One common motivation is alpha-driven trading, where managers buy or sell securities based on forecasts of future outperformance or underperformance. Rebalancing trades are another important category and occur when portfolios must be adjusted to maintain target asset allocations, risk exposures, or benchmark weights. Cash flow management also generates trading activity as managers invest incoming funds or raise cash to meet redemptions. Additional motivations include implementing tactical asset allocation decisions, adjusting factor exposures, responding to changes in benchmarks, and complying with client mandates or regulatory requirements. Each motivation influences execution priorities and acceptable trade-offs. The urgency of a trade often depends on its underlying motivation. Alpha-driven trades are generally highly sensitive to timing because expected opportunities may disappear quickly as information becomes incorporated into market prices. Delayed execution can reduce or eliminate anticipated gains. In contrast, rebalancing trades may be less time-sensitive because their primary objective is maintaining portfolio structure rather than capturing a short-term opportunity. Liquidity-driven trades may require immediate execution regardless of market conditions. Understanding trade urgency helps managers determine the appropriate balance between execution speed and transaction cost minimization. Execution strategies should therefore be tailored to the specific objectives, constraints, and risks associated with each trading decision. To evaluate execution quality, managers compare actual trade prices with reference price benchmarks. These benchmarks provide objective standards against which execution performance can be measured. One commonly used benchmark is the arrival price, which represents the market price at the moment a trading decision is made. Comparing the final execution price to the arrival price helps assess the costs associated with delays, market movements, and execution decisions. Other benchmarks include the previous closing price, opening price, volume-weighted average price, VWAP, time-weighted average price, TWAP, and implementation shortfall measures. Each benchmark serves a distinct purpose and provides insight into different dimensions of execution performance. Implementation shortfall is one of the most comprehensive measures of execution quality because it captures the difference between the theoretical return of an investment decision and the return actually achieved after execution. This metric incorporates explicit costs such as commissions and fees, as well as implicit costs including bid-ask spreads, market impact, delays, and missed trading opportunities. By measuring the total cost of implementation, managers gain a more complete understanding of execution effectiveness. Implementation shortfall is particularly useful for evaluating whether trading strategies successfully balance execution speed with transaction cost control and whether portfolio managers are effectively converting investment ideas into realized performance. Volume-weighted average price, VWAP, is another widely used execution benchmark. VWAP represents the average market price of a security throughout the trading day, weighted by trading volume. Execution prices better than VWAP are generally viewed favorably because they indicate trading occurred at prices superior to the average market participant. VWAP is particularly useful for evaluating large institutional trades because it reflects prevailing market activity. However, it may not always be the most appropriate benchmark for highly urgent trades or situations where market conditions change significantly during the trading period. Managers must therefore select benchmarks that align with the specific objectives of the trade being evaluated. Trade execution strategies are designed to achieve desired exposures while minimizing transaction costs and market disruption. Aggressive execution strategies prioritize speed and certainty, often accepting higher market impact costs to complete trades quickly. Passive strategies seek to minimize market impact by spreading orders over time and trading gradually alongside market activity. Algorithmic trading techniques such as VWAP, TWAP, participation rate algorithms, and implementation shortfall algorithms automate execution decisions according to predefined rules. These approaches allow managers to manage large orders efficiently while reducing information leakage and adverse price movements. Selecting an appropriate strategy requires consideration of liquidity, volatility, trade size, urgency, and market conditions. Successful trade implementation requires integrating portfolio objectives, benchmark evaluation, and execution strategy selection into a coherent framework. Managers must understand why a trade is being executed, determine the most appropriate benchmark for measuring success, and choose an execution approach that balances cost, speed, and risk. Continuous monitoring and post-trade analysis help identify areas for improvement and refine future execution practices. As financial markets become increasingly complex and technology-driven, execution quality remains a major determinant of investment outcomes. Effective execution transforms investment insights into realized portfolio performance and represents a vital source of value creation within the broader portfolio management process.